Hey guys, this is Chris with Million Dollar Earnings, and we're here to talk about one of the Greeks in stock analysis, beta. More importantly, I'm going to explain to you why it's absolutely useless for doing options trading, especially when you're taking positions that are only a week or two out. After watching this video, if you found it helpful, please make sure to hit the like button and also hit subscribe so you see other videos from me as I post them on options trading strategies, terminology, and tips just like this one. Also, if you're not familiar with my site, I am on a journey to build $1 million a year income using options trading. The URL is in the comments below the video, and I welcome you to come check it out and follow me on my progress. Okay, now that we've covered all of that, let's get into our topic of the day, beta. When you open an options position, you'd like to have the highest confidence that if the stock moves, it's going to move in the direction you want it to. Chart analysis indicating known patterns can help with this, showing you which direction the momentum is heading or likely to move. It also helps to know that a stock isn't very volatile or likely to switch directions unexpectedly. When talking about volatility in stocks, one of the Greek terms that might get brought up is beta. While beta is a measure of volatility, it's not the one that you're looking for. I'll tell you why. Beta is a measure of the volatility of a security compared to the market as a whole. The lower the beta, the less volatile a stock is, and the higher beta indicates more volatility. Stocks with betas higher than 1.0 can be interpreted as more volatile than the market it resides in. Simply put, beta is a measure of volatility. I don't want to get statistical with you, but beta is nothing more than the slope of a line that goes through a series of data points. These data points are the stock's returns compared to the market, and these data points are from a long period of time. If you look at Yahoo Finance, you'll see that stock betas shown here are the 5-year monthly average. That's a long time. But what is volatility? Volatility, when referred to in options trading, is a measure by which the individual stock is expected to fluctuate over a given period of time. It is the amount by which the underlying stock can change during the life of the option. In options trading, the expected or implied volatility is often measured against actual historic volatility. For example, if Apple stock has an annual volatility of 40%, then it would be expected to move up or down 40% in price on an annual basis. The volatility is based on its own independent movement. Notice how this is different than beta. If Apple stock has a beta of 1.22, it would be expected to move at a rate of 122% of the fluctuation of the NASDAQ. Beta is the stock's movement relative to the index. Tying this back to options, a stock with a high beta, greater than 1, offers the possibility of a higher rate of return, but also poses more risk. But if you found a company in that same industry with a beta of 0.8, this would tell you that the company is less volatile than the market as a whole and relatively stable compared to its industry. Depending on which strategy you use, this could be a good or bad thing depending on whether you're looking for price stability or rapid price growth. But this looks out over a long horizon and is based on a long history. Not so good when opening a position that expires next week. So if it's not good for options trading, who does use beta? Beta is used out there, but it's more for portfolio managers and sophisticated traders with large portfolios of stocks. They can either increase or decrease their exposure to the market using the beta calculations to help hedge their portfolio. Beta is an important data point for looking at things on a large scale like this, but it's just not going to help you understand the potential volatility of any given stock in the short term. When you're discussing short-term options, beta and volatility are not the same thing. So if you're not using beta, how can you determine short-term volatility? This is the question we really want answered. How do I know a stock isn't going to reverse course on me in 2 days? If I open a trade expecting a stock to maintain its current stability, and then tomorrow it drops significantly, chances are I just lost a bunch of money. So how do I know this won't happen? This is where you have to look at the calendar. Know what's going on that could affect that stock over the next couple weeks. Here are some of the things that you should look at. Earnings releases. Anytime a public company has an earnings release, the stock is likely to react. Beat expectations, and the stock might jump. Miss expectations, and the stock might drop. Both of these are likely to be significant and can easily take your position into a loss. Major competitor earnings release. It's not just the company whose stock you're opening the options position on that you have to watch. When major competitors have surprises in their earnings release, it can also affect your company. Sometimes these are going to be macro events, which will make company stocks move in parallel. And sometimes one company will stumble, opening the door for the other to capitalize on market share. In a case like that, the stocks might move in opposite directions. Fed interest rate changes. This is most critical when rates are heading in one direction or the other. It becomes a game of chicken to see how far they're going to move and how the market is going to react to it. This is one of the things that affects all stocks, not just one company. But it won't matter to you that every other stock is moving, just that your stock is moving too. Consumer price index and producer price index releases. When inflation is high or climbing, traders are going to be keeping a close eye on the price indexes. When these rise or fall faster or slower than expected, it can cause large movement of markets. This is another one that affects markets broadly. Planned product launches. Getting back to company-specific items, a new product or service launch can cause a stock to move dramatically. If it's an unexpected new product or a product that disappoints, stock movement can be pretty significant. Short-term volatility is event-driven, and any one of the items I just covered are scheduled to occur before your position's expiration. You need to consider them in your strategy. The bottom line is you need to identify the things that could cause volatility for your stock and reduce the chances of it affecting your position. It'd be nice to have a single data point to look at when we want to know if a stock is likely to move much, but the fact is, there just isn't one. Beta definitely doesn't give us what we need. But that doesn't mean we can't mitigate the volatility risk. You just have to know what things to look for before you open your position. If there aren't any events like what we just covered coming up, chances for significant movement by your stock are much lower. Combine this with some basic chart analysis, and volatility becomes a much smaller item to deal with. Beta is useless for determining potential volatility with your stock for short-term options positions. But that doesn't mean there aren't other things to look at. Forget about beta and use some of the items I've called out here to understand what items might impact your stock over the next week or two. And that's why beta is useless for options trading. Thanks for watching. I hope you liked this video. And if you did, please make sure to hit the like button below. And if you haven't done so already, make sure to hit that subscribe button to see more videos just like this.